Hello, everyone. This is Joe Zappia from LVW Advisors, and I'm here with my partner, Jonathan Thomas. And this is the first quarter 2022 State of the Markets. Let's kick things off by just talking a little bit about calendar year 2021 across various different asset classes and the kind of returns that we saw. 2021 was really an amazing year for the US stock market. The S&P 500 ended the year up 28.7%. And this comes on the heels of a great return in 2020 and 2019. All told, the 10-year average return for the US stock market now sits at 16.5% through year-end 2022. The other thing that stands out to me on this chart is how poorly bonds performed last year. Although not really a surprise, bonds were a bad place to be. US bonds were down 1.5% as measured by the aggregate index. And international bonds had a really difficult year, being down 8.7%. And then the only other comment I would make, Jonathan, is the US market really outperformed international markets, not only this year, but the return is really exaggerated over 10 years. If you look at international stocks versus the S&P 500, the S&P is up almost double. And then the other thing is real estate and commodities were both up over 40% in 2021.
Quite a year. And I'm looking at some of the top headlines for the year, Joe, 2021 in front of me. So remember, January 6th, we had the insurrection, okay? We had the COVID vaccine, which was rolled out successfully, but we also had two variants. We had the Delta variant, Omicron variant. We had the highest inflation in 40 years. And then we saw the rise and fall of some active managers like Cathie Wood and some of the meme stocks and cryptocurrency and some volatility. And still, the market was up almost 30% last year.
Yeah, pretty remarkable.
So looking at different asset classes going back the last couple decades or so, the power of diversification. So if you look at the gray boxes, this is an asset allocated weight of all the different asset classes, right? So if you look at equities, bonds, commodities, real estate, and you just own a basket of those, you've done really well, right? You're never going to do the best. You're also never going to do the worst. And you're going to do pretty well with lower volatility. And so last year, you own a basket of all these asset classes, you were up something like 13%. So overall, it was a good year across the board if you were well diversified.
Absolutely. So
to start the year, now, of course, when we record this, things are just kind of going crazy, right? So we're not really sure what's causing what or what the end story is going to be by the time you're listening to this. But the market's down about 8% year to date, the S&P 500. And we showed this slide last quarter because we thought it showed or painted a really good story because it speaks to valuations. And on an absolute basis, if you just look at stocks, if you look at any multiple, if it's price to earnings, price to sales, stocks are very expensive, probably almost as expensive as they were during the tech bubble. And really, besides the tech bubble, one of the most expensive times ever in history. But if you look at stocks on a relative basis compared to bonds or cash, they look really cheap. And that's because interest rates are very low. However, we're pricing in higher interest rates. Now, with higher interest rates, stocks aren't going to look as attractive to bonds as they did a year ago. So that's what's maybe causing some of the uncertainty in the markets and volatility that we're experiencing.
Yeah, I think you hit on a key point right there. So valuation is a really terrible short-term predictor or indicator for the stock market. But over the long term, it's actually incredibly reliable. And we've had, I think the number now is 12 out of the last 13 years have been positive for the S&P 500. And although earnings have been good, and we'll show you that in a second, valuations are pretty stretched, and it's all a result of ultra low interest rates. So what's changed? The Federal Reserve has now told us they're going to start raising interest rates and taking liquidity out of the system. And that's probably what's causing some volatility right now, because as interest rates go up, stocks begin to look even more and more expensive. So let's talk a little bit about volatility. We've shown this chart before. This goes all the way back to, I think, like 1980, and it just shows you that the gray bar is the annual return for the year for the market as measured by the S&P 500. And the red dot each year is the maximum drawdown any given year. So you can see that in 2020, of course, we had the COVID bear market where we had a 34% drawdown. And we've got it circled all the way over to the right, 2021. 2021 was actually an incredibly low volatility year. You had the market up 27% on a price basis, 28.7% on a total return basis. And we only had a maximum drawdown during the year of a 5% correction. And I'd just like to remind everybody that the market on average corrects about 10% about once a year, and it will correct historically about 5%, somewhere between 3 and 4 times a year. So volatility is normal. So if anything, we're moving back into a more normal environment if the first 26 days of January are any indicator so far.
Yeah, and I would just add that there can really be no return without risk, right? Like we need uncertainty. We need these negative headlines. We need volatility in order to get returns like we saw last year, 27% or 16% annualized over the last 10 years. If there was no risk and there was no volatility, there would be no return. That's just kind of how these things work.
One of the things that I think that kind of gets lost in a lot of the conversations is the tremendous bull market that we've had coming out of the great financial crisis in 2009. And we just talked to you about how the compound average return for the S&P 500 is 16.5% a year over the past decade. Well, what's interesting is my point earlier about valuations and earnings. The stock market really does follow earnings. And if you look all the way over to the right, the decade of 2010 to 2020 was the single best decade for corporate earnings, real earnings growth, going all the way back to 1870. So to the shock of many, given all of the negative things that have happened in the world and all of the uncertainty that we've seen the past 10 years, corporations are doing a lot better. Maybe it's technology, maybe it's people, but in general, corporations are making more money and profit growth has been great and the stock market followed. The one point I would add to this, however, if you really dig into this chart, and I don't say this to be negative, but if you look at decades of really strong positive returns, historically, they are followed by decades of significantly lower corporate earnings. And who the heck knows what's going to happen in the future? We don't try to predict anything, but if history is our guide, after a really strong decade of earnings, sometimes you see below average earnings for the following decade. One of the things that I think that is really worth mentioning or talking about is, and this is a pretty technical chart, but I think it's super important. And all this does is compare the types of companies in the S&P 500. One is the Russell, well, actually it's the Russell 1000 Growth Index compared to the Russell 1000 Value Index. So you've got the 1,000 largest value companies and the 1,000 largest growth companies. And the orange line is when growth is beating value, and the blue line is when value is beating growth. And you can see that going all the way back to 1980, we're ending 2021. This actually goes through 116 to 22, with the widest margin of outperformance of growth companies over value companies. And I think mean reversion, and we've talked about it before individually, I've talked about this a lot when we're talking about the world and the markets. I think assets are generally mean reverting, asset class returns are mean reverting. And I think that we'll start to see value begin to perform better and better. And actually, if you do a historical analysis of when the Federal Reserve is raising interest rates, growth tends to perform very poorly, especially relative to value, because generally growth stocks don't pay much in the way of dividends. So you're pricing them based on future earnings, cash flows. And when the current cost of capital is higher, when you discount those future cash flows back, you cannot justify paying the same kind of multiples for some of these high growth companies as you did when money was free.
Yep, absolutely. I think the next slide kind of goes hand in hand with a little bit of that commentary, Joe, and it's talking about non-profitable versus profitable stocks. So non-profitable stocks, I think of growth stocks, specifically some of the speculative names not growth in the way of like Amazon or Google, but ones that don't have any earnings, obviously, or just have crazy valuations. And so from 2020 to 2021, so May 2020 to May 2021, non-profitable companies crushed profitable stocks. So companies that actually have earnings, actually pay dividends, they just got destroyed by the ones that don't. And then since, so May 2021 through December 7th, so it's probably gotten even worse. It's been the complete opposite. So companies that actually make money are doing really well. Companies that aren't are getting crushed.
This is another chart that I think is super interesting. I follow inflows and outflows into various asset classes for the better part of 15 years. I pay attention to the data when it comes out every 2 weeks from Bank of America's Global Research. And 2021 was a pretty interesting phenomenon. We had more money flow into equity ETFs and mutual funds in 2021 than the prior 19 years combined. So it was the largest inflow of money into stocks in history. Over $1 trillion flowed into stocks in 2021. And as you can see on this chart going all the way back to 2006, this dwarfs any inflows from the past. And if you think about the stock market as an auction, and you think of the auction in terms of buyers and sellers, and if you think in terms of the buyers having a whole bunch of cash, buying a finite number of companies, historically, when money flows into the markets, prices go up. Now, when money leaves the markets, of course, prices go down. And I know that nobody likes to oversimplify the stock market to that level, but I actually think it's essential to understand how asset pricing works. When there's more money chasing stocks, they tend to go up. And when money needs or has other alternatives, stocks will tend to go down in price. This historically has been a contrarian indicator. So usually when money is leaving stocks, it's historically a very good time to buy stocks, because when money is leaving stocks, prices go down. And historically, when you've seen strong inflows, it's a general indication that stocks are expensive and potentially vulnerable to lower prices. And that just has a lot to do with the average investor tends to sell stocks when prices are low and the news is bad, and they tend to buy stocks when prices are high and the news is good. So if we were to use this as a contrarian indicator, this would be flashing caution. This is a chart that's in our first quarter LVW newsletter that I pulled from Bloomberg, and I think it's also worth talking about here. And that is that we keep getting questions from clients about what we're going to do because the Fed's going to raise interest rates. You know, what does it mean? What should we do in portfolios? What's going to happen? And one of the things that I always say is that typically news follows price. And what I mean by that is that many times prices will move in advance of the actual event. Markets are discounting mechanisms. So several months ago, Fed Chair Powell started talking about the idea of removing stimulus from the market, and that an eventual rate hike was coming. Now, his hand may be forced to raise rates a little bit faster than maybe he wants to or planned on raising rates because of some persistent inflation. But the reality of it is if you look at the 2-year Treasury bond yield, and this is just a 2-year Treasury, any one of us can invest in it. The 2-year Treasury yield is, and it has effectively been pretty darn close to zero, maybe 0.25%, pretty much from March of 2020, when the Fed got super accommodative after the COVID economic shutdown. But if you look at the green line, which is the actual 2-year Treasury yield, yields began rising in the fall and have risen pretty rapidly leading into the end of 2021. And right now, the 2-year Treasury bond is yielding over 1%. And if the Fed raises rates 1/4 point each time they raise rates, what this means is that the 2-year bond market has already built in or priced in 4 rate increases by the Fed. So what does this mean? What it means is that markets move faster than you can move. And it doesn't really, and so when the Fed talks about raising rates, in many ways, just them saying they're going to raise rates adjusts the bond market almost instantaneously.
How about international stocks, Joe? I know that there's a lot to discuss here, just given how long we've gone of US outperformance.
Yeah, for sure. I'll talk about this a little bit, Jonathan, then you can jump in with any comments you have. Over the past really 10, 11, 12 years, US stocks have outperformed the rest of the world by about 275%. I think it's been 14.1 years. Yeah, it's on the chart there. 14.1 years of outperformance by US markets. And, it's super easy as an investor to sort of talk yourself into, we call it confirmation bias, talk yourself into the idea that the US is the best place to invest. It's the only place to invest. And it's also super easy to talk yourself out of investing outside the US, particularly now with what's going on with Russia and the Ukraine, China and Taiwan, some of the energy problems, and the lack of a real monetary authority in Europe, aging demographics, et cetera. And of course, in the US, we have all the great tech companies from the world. We have great healthcare companies. We've got low taxes, great rule of law, really efficient stock markets. I'm giving you all the reasons to own US stocks and not own the rest of the world. But the reality of it is when you build a diversified portfolio, to the point of the chart that you shared with us a few minutes ago, you have to own stocks from around the world to be truly diversified, because you never know where performance is going to come from. And building a portfolio that doesn't have international stocks is, and this might sound corny, but it's like trying to write a book with half the alphabet. You just can't do it. And even though the US has been outperforming for a long period of time, it could continue to outperform for many more years. Or what's more likely to happen is we'll probably reach a point where international markets perhaps will start to once again outperform the US. And then there's just one, and then you can actually go to the next slide unless you have comments.
Well, I guess the one thing I would just point out is just like how crazy this is. I mean, 14 years, that hasn't been one rolling 12-month period where international stocks outperformed US. It's not just year to year, it's rolling 12-month period. So it's amazing that it's gone on this long, where there would be a change or a change in leadership every maybe 3 to 5 or 6 years. We're now at 14 years.
Yeah, it's true. I think it's a result of a couple of things. So to me, it's not really surprising. I think it's the result of very accommodative monetary policy, and also that the majority of the world's technology companies are based in the US. And over the past decade, we've had a rise of some of the greatest companies in the world, like Apple, Google, Amazon, Facebook, et cetera, that are all US domiciled, but truly global companies. But, there's many great companies that are also domiciled outside the United States as well.
Mm-hmm. Yeah. Okay. Yeah. Let's look at the next one. This is specific to emerging markets, not just broad international.
For sure. And, emerging markets have been cheap for a while. We on our investment committee at LVW, we look at valuation charts every Monday morning. We run the same set of charts, and we just look for pattern recognition. And I can tell you that when we look at it, emerging markets on a valuation basis have been the cheapest markets in the world for many, many years. So that second or third chart that we shared that showed valuations in the United States based on things like price to earnings ratios and price to sales, et cetera, are the most expensive in history. You would see almost the opposite if we were showing you the same metrics for emerging markets. That having been said, emerging markets are a pretty difficult place to invest right now for some of the reasons that I mentioned before. But there is a piece of historical anecdotal evidence that I do like to point out. After an incredibly strong decade of returns in the US stock market from the period of 2000 to 2009 or 2001 to 2009, when we basically came out of the dot-com bubble and then went to from 2001 and 2009, let me rephrase this. So from 2001 to 2009, the S&P 500 had what was called the lost decade. And That last decade, the S&P compounded a return of about -1% over that period. And that came after the decade of the 90s when the market returned, I think, north of over 20%. The S&P 500 was up on an annualized basis year after year. So not that different than where we are today in terms of historical returns. And then during that period where the US stock market compounded at negative returns for a full decade, emerging markets, the asset class of emerging market stocks, compounded at a return north or a little bit higher than 7% a year over that same period. So there are reasons to be diversified among the stocks you own as a risk reduction tool or a diversification tool. Even if you feel more comfortable and confident owning a company like Apple because you use their products, you understand the company. There are points in time where prices get to a level where it's difficult for those prices to go a lot higher, and money will eventually seek places where there's great value. So emerging markets are interesting right now because they definitely represent a lot of value relative to the US.
All right, let's flip over to some fixed income or bond discussion. We've talked a lot about equities, a lot about stocks, markets, fixed income. So going back to 1981, there have only been 4 years in which diversified fixed income US bond portfolio was negative for the year. You can see they're not negative by much. So last year bonds were down, what, maybe 1%, 1.5%, never even down as much as 5% in any given year. So it is unusual, but it is worth pointing out. Given where we are with interest rates being so low and interest rates likely to go higher, it could be likely that we have another negative year or a very small positive year. It's going to be really hard for bonds to make much of a return given how low interest rates are. But remember, bonds are really to act as the ballast of the portfolio, right? So we own equities for the growth, but we know that it comes with volatility. So you own bonds to kind of smooth the ride. And so they're doing their job, as you can see, by having very low volatility.
Yeah, so here's, just go back for 1 second, Jonathan. Yeah. I just want to add one thing, because as we're recording this, we're in the middle of one of the most volatile periods for the stock market that we've seen in a long, long time. In the intraday swings between 9:30 a.m. and 4 p.m. for the NASDAQ index this week have been wider each and every day this week than the worst annual return for the bond market going all the way back to 1980. Just to your point about what is the old saying? A bad year for bonds is better than a bad day for stocks.
Yeah, that's it. Well, something like that, but you get the point.
Close enough. You get the point.
Yeah, exactly. And so investors, you may be looking out and saying, well, I'm only getting maybe 1.5%, 2% interest or income on my bond portfolio. I would like to reach for yield, right? I want to own preferreds or REITs or high yield bonds or even MLPs that are paying like 8%. But just know that it comes with a lot more risk. So you see on the top, that's just your average annual income or dividend yield from some of these different asset classes, including stocks over here on the left. But the worst 12-month rolling total return. So like worst case scenario in the last 30 years or so, how much have these asset classes dropped? You can see diversified fixed income, the worst case -2.5. But you go out a little bit further and you try to pick up 2, 3, 4%. I mean, you could be losing your shirt basically, right? 30, 40, 50% in a given year. So it's really not worth the risk, right? So we've kind of been talking about this for years, right? Let the fixed income side of the portfolio be your safe money and really protect and preserve your capital. Let the growth be with the equities. And I think this slide does a good job of explaining that.
Yeah, absolutely. And I can just, again, just talk a little bit about experience. I've lived through several disruptive markets, bear markets, and I can tell you that correlations go to 1. And what I mean by that is when things start to drop, almost everything drops with it. When stocks drop, preferred stocks drop, rates drop, high yield drops, MLPs drop. But the one thing that really doesn't are US Treasury or high quality fixed income. So Jonathan's point, we actually believe in portfolios that you're better off just accepting that 1.8% return that's shown on the circled area of the chart rather than stretching for yield. Because when you stretch for yield, your portfolio is going to move in the same direction at the same time more if you become less diversified.
Absolutely. Okay. Last slide here, Joe.
So LVW has an investment committee, and our investment committee each and every year creates capital market assumptions for the forward 10-year period. They're dynamic. We use multiple sources and multiple inputs, and we do a regression analysis. And that's what you're looking for, what you're looking at here today. We just completed our capital market assumptions for the next projected 10 years, beginning on January 1st of 22. We're going to be directionally correct, we think, but the variance of our estimates will probably be somewhere in the area of like plus 2.5%, minus 2.5% to each asset class. So let me explain what this means. US large cap historically returns about 10.9% a year. This goes back a long, long time, 70 plus years of measuring the S&P 500. Our projected return for the S&P 500 for the next 10 years is 4.8% a year based upon a whole bunch of factors: starting PE, starting dividend level, historical past returns, expected volatility, et cetera. Small cap has always been the highest performing US equity sector or asset class over very long periods at 11.6%. We think small caps are going to do a little bit better at 5.8%. International markets, again, based on their valuation, are cheaper to us. So in our view, international markets probably offer the highest expected return in the equity part of the markets at 6.4%. And we think fixed income, while not as good as historically measured, and that has a lot to do with the fact that interest rates have been declining since around 1980 or 1981, will still have a positive return of about 2% a year. And we actually think cash will average around 1% a year as the Fed begins to raise short-term interest rates. That'll help savers and people that are holding cash in money markets. So what's all this tell us? All this tells us that forward returns are very likely to be lower than the recent past returns. US stocks over the past decade have returned about 16.5%. If the 100-year average is 10.9, that doesn't mean the next decade needs to be something terrible, but it probably means it's something less than 16.5. And there's all kinds of different things that are stacking up on the side of more muted returns for stocks and lower returns for bonds. The starting point that we're looking at this, valuations are pretty high and prior returns are pretty high. And in terms of fixed income, as Jonathan said, the starting yield is pretty low by historical terms. And bonds will typically only give you what the yield is. And we expect the 10-year treasury to yield somewhere in the 2 to 2.5% range. And that's how you end up with a fixed income return of around 2. So all told, what it means is that we all need to accept the idea that returns are likely to be positive, but just not likely to be as good as they have been. And it also presents opportunities for asset allocators like LVW or stock pickers to add value by investing in areas that are particularly cheap or offer opportunity. And then the last point that I would add, and I think this is critical, is that we don't know the path to this 4.8% expected returns for US stocks. It could be 4.8% a year for the next decade, but I think we all know that that's probably not pretty likely. It could also be a situation where we have a 30, 40, 50% drop in 2022, and then we spend the next 9 years going up by 10 or 12% a year to get back to that expected return. Or, some random variable annual return in between. And I think that as investors, we just have to make sure that we understand where our risk is, how our portfolios are diversified and allocated. And we believe that we have portfolios built correctly for this lower return environment, and stand ready to rebalance when opportunities present themselves, because systematic rebalancing will naturally buy things that have gone down and sell things that have gone up. So as we're rebalancing today, we're seeing a reduction in stocks after significant appreciation of stocks. And it's this continual systematic management of portfolios that lead to good, solid results over the long term.
Yeah, well said. I think what might come to mind is, you may ask, why do we use historical returns when we build financial plans? And that's because we are building financial plans for decades and generations. right? Not just the next 10 years. So what you're seeing here is projected 10-year returns, not projected 50 or 100-year returns. In that case, it makes sense to use a historical return. And keep in mind, we also stress test the portfolio in the financial plan. So we're assuming that there are going to be years and decades where we have 4.8% a year, and fixed income only returns 2% a year instead of 7. So we are focusing on, the Monte Carlo simulations and stress testing the portfolio and some of the lower return environments into the plan. So it's all being accounted for.
Yeah, and I think that's a great place to stop, is just to remind everybody that if you would like to talk with us and have us do a risk assessment of your portfolio, or to show you some of the Monte Carlo simulations that we can run relative to your financial plan, that's why we're here. Please feel free to actively reach out to us. And if not, we'll be talking with you all soon. And I'd like to thank you all for making it to this point in the video, and we look forward to seeing you soon.
Yes, thank you all.